football, the red zone is where a team has to make small adjustments to ensure victory. As you approach retirement, you also need to make small adjustments to ensure success. This is the Red Zone Retirement Program with registered investment advisor and enrolled agent John Mears of Mears Money Management.
Hi, Coach, what's going on this week? We're going to tackle the BBB. It got passed, as we all know, and we figured we might as well just get in here and have a little bit of a conversation. I know you still got a lot more reading to do on the details, and there's more details that need to come out, but we thought we would tackle at least some of the main topics, because you've already been getting some questions about some of the stuff, right? So we figured we might as well do it this week on the podcast. How you doing, brother?
Doing good. And we do have some answers. This isn't quite to the point of we got to pass the bill to see what's in the bill. It's not quite that bad.
No, they definitely read it.
Going on. So we do have the highlights here. There's going to be some nuance, I'm sure, as we go along. There's going to be things that the IRS that always gets punted to the IRS to figure out some things as well.
Oh, yeah, figure it out later. Yeah. We made this rule. Y'all figure out how to make it work, kind of thing.
Yeah. So, but we do have the highlights here. We'd like to go through them. And for my clients, I'll be following up probably the next few weeks with a little more detailed mini webinar. But for what we're doing today, this kind of gets out to some of the broad brushes of what people are asking about already. So hopefully people will find this helpful and beneficial to what they're thinking. So.
Well, let's start with a big one that fits a lot of our demographic and your demographic for clients. And so we're going to debunk a few myths here a little bit. And it's number one, that Social Security is no longer taxed. It's sort of for some people, right? Basically it's still subject to tax, but there's credit here is what's going to be a little bit of a difference. So depending on what you earn. Yeah.
They did a whole end around on this. It really doesn't, this is probably the biggest myth that's out there because we've been hearing for so long that's one thing that the president was running on was that he wasn't going to tax Social Security. But when Congress got together with the Senate and they kind of went back and forth, they couldn't quite agree on anything. So what they did is basically the way Social Security is taxed, the way it's actually calculated is the same. What they have done is they've actually added, though, a $6,000 deduction for seniors age 65 or over. Now, that's a pretty big deduction. So that may make it for a lot of people, so they won't be paying any tax on their Social Security earnings. So that's a big deduction.
Right.
What's cool about it is this isn't just for added to your standard deduction. You can itemize and still get the $6,000 over 65 deduction. So it's not just a standard deduction, it's a over 65 deduction, which is pretty helpful.
Yeah.
It does phase out. So if you are a married couple,
4 years, 2029, I think, right?
Yeah, well, I'm talking about the income phase out. There's an income phase out at $150,000 for married couples. It phases out completely at $250. For individuals, it starts phasing out at $75. So there are some phase outs. So I know people keep saying, you hear on the news that this is a tax cut for billionaires. It is not. This is definitely aimed at lower income seniors, and it will prove very beneficial to lower income seniors. If you have a pension and you have other sources of income, this will still help you, though. This will still be helpful because most of my clients, their income is, with their pensions, their Social Security, and maybe their IRA distributions. Most of them are under 150 to 250. So most people will enjoy some added tax relief for this.
Yeah, some level. Yes. So to your point about the phase out, so for couples, for example, it's $250,000. If you make more than that, you wouldn't get this extra exemption.
You wouldn't get the $6,000. You'd be right back to where you were, 2 weeks ago.
Well, six for an individual, 12 for a married couple, right?
Yes.
Yeah.
Yes.
Okay.
$6,000 per person. Yes.
Per person.
Point that out.
Yeah.
Again, we're kind of jumping around here, but that's what's really super beneficial as well. It is per person, so that's really helpful for people. So thank you for reminding me about that.
No. And I'm sorry if I've got you messed up because on the phase out too, I was thinking that the senior deduction, this particular piece is set to expire in 2028. Unless, of course, that Congress at that time chooses to extend it or not.
And we will be talking about this as we go through the debunked myths that permanent isn't always.
Well, that's true too. Yeah. So that's the first big one, right? So there is Social Security is still taxed, but there is this new, tax spot,
huge help,
exemption for some people, big help. Yeah.
Yes,
all right.
It's a huge help, but Social Security is taxed.
It's still taxed.
So So if you were going to be subject to tax, you're going to be subject to tax for
that's the key word. You're still subject to tax. We'll just, depending on your incomes and so on and so forth, you may get this exemption for a little bit. All right. Myth number 2, the new law means tax cuts for everybody. Sort of.
No, just like we just said, this isn't the Oprah thing where we're just getting tax cuts for you and tax cuts for you and tax cuts for everybody. Right. It's not quite that way. But as we just discussed, for Social Security, it does phase out. And I do have some clients that even in retirement do well, and they will be making more than the $250 phase out for the Social Security. So there are limits. And again, to debunk what you may see in the media, it is aimed at lower income people. If you are making more money, so like the SALT deduction, which we're talking about in a second,
that's going to help people in high states for sure.
Yes, it'll help you in high states. But again, if you make over $500,000, it starts phasing out. So if you're rich, depending how you want to define rich,
right?
But if you are somebody who's wealthy, the SALT deduction does phase out.
Well, it goes from what, 10 grand to 40 grand, right? 40. So for people in high state and I guess we should define
California.
SALT is state and local tax, by the way, right? For people who are like SALT tax, am I paying tax on salt?
Pepper's coming,
pepper's coming. But California, New Jersey, so on and so forth, New York State, blah 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 blah. Other states that have higher state and local taxes, that could be a benefit from 10 grand to 40, because that was 10 grand regardless if you were married. It wasn't like 10 grand per person.
Yes, correct.
Yeah,
correct. So, it is a big boost for the SALT deduction, but again, it does phase out. So again, it's not a tax deduction for everybody. If you are, and here in California, it is not unusual for somebody to make more than $500,000. Here in Southern California, we call that middle class. So here in California, if you're making more than $500,000, if you're in New York City, where again, the same thing, where if you're living in the city, you're
probably middle of the road. Yeah.
Yeah. And so it isn't for everybody. And so it will start phasing out, but there are some great tax deductions in here or changes to the tax law, which will help, I would say, many, many people. Again, it is geared up towards the lower tax brackets and small business owners.
Okay. All right. Well, you alluded to this one, so this one should be real short and sweet. Myth number 3 is the tax brackets. It was made permanent. The BBB, the TCJA, let me rephrase that. The TCJA Tax Cuts and Jobs Act was made permanent. So I don't need to worry we're going to be in this tax rate forever.
Define permanent, if you will.
Washington's permanent is not the same as everyone else's permanent.
Yeah, I don't know how we'll define that. And when we get President Gavin,
in a
few years,
no.
If we get President Gavin in a few years, things could change. So we have to.
That's the key,
understand
right?
That.
Yeah, that's the key, right? So so right now, by making the TCJA permanent, the tax code that we've been under for a while now is basically extended for, we'll probably just say at least 4 years, right? Because the next election will happen. If, a different administration comes in, which obviously will, they may choose to do something different. So for now, it's permanent for 4 years.
And there's always people forget this. And I've talked to my tax clients for 35 years about this, that one way for Congress to really get around the tax law is they can always change the tax brackets, the levels of the tax brackets.
Yeah.
And so that's something that can, no matter what was just signed last week, what we now understand to be law, if they increase the 12% bracket up, there's still a 12% and a 22 and a 24% bracket.
Yeah.
But those thresholds could be higher, so you're paying more, or lower. Let me reverse that.
Yeah.
Lower, which means you're paying more tax at the higher tax brackets.
Yeah.
So they can definitely mess around with the tax brackets in the future. It's easy to do, and nobody pays attention to do that in the press.
John has a couple of free books, Diffuse and Tax-Free Retirement in California, that reveal exactly how you can experience zero taxes in retirement and overcome the IRS lien on your 401k, IRA, and 403b, which could threaten your future lifestyle. These are complimentary, so all you have to do to pick these up 100% free is just stop by RescueMyRetirement.net. That's RescueMyRetirement.net. Fill in the basic info and he'll ship those out to you immediately. That's RescueMyRetirement.net for a copy of Diffuse and Tax-Free Retirement in California.
Well, all presidencies have the same idea. Right? They come in and they set up, whatever their tax law is going to be. So, for example, when he won the first time and he became president, and they put the TCJA in. They were hoping to have 8 years, right? So you'd have it go for 8 years. They would have extended it, and then the next administration that would be coming in technically now, or this, here in 24, 25, would have probably changed the tax code. Well, obviously we had that little, different interruption there when we had Biden become president in the middle. So now basically the next administration that comes in 28 will have to decide, do we let the TCJA cuts still ride? Do we like that? Or do we make a change? So that's why permanent is only as long as the next administration.
Correct.
Yeah.
So
it's a shell game.
It is a shell game. I always tell people we always have tax planning, and I've said this so many times. Tax planning is a year-round sport. It doesn't matter what they have put into law. There's always planning that needs to be done. There's always stuff. Roth conversions are still in play. Things like that. There's still things that we have to do that still matter because we're still trying to pay the lowest tax legally possible.
Yeah.
And this law didn't repeal taxation, folks.
No, still there.
So there's still tax laws out there, and we still have to pay attention to the existing tax laws.
But I will say that, by extending the TCJA, at least, even if it's just for the next 4 years, from your standpoint, from a lot of people's standpoint, from a tax planning standpoint, this is good news, right? Because a lot of people were talking about Rothing over time. And of course, the time window was getting short. Well, now you've got 4 more years to Roth over time. So at least you're in the same tax bracket that you've been in for a little while. And the good news about versus the last time when this TCJA was first put in, what they do it like in December. And then I think it kicked in like January. So at least they got this done in July, right? So we know.
There's a little bit better runway there for planning purposes. There's a little more certainty, I guess, is a better way to put it. Right now, we have a little bit better baseline. So will we still do Roth conversions? Yes, but now we don't have to quite worry about the impending doom when the sunsetting was occurring with the TCGA before.
Gotcha.
So,
okay.
So do we plan? Yes. Do we still do it? Yes. But now we have more certainty as to what the future holds.
Fair enough. So back to the myth, permanent is only as permanent as Washington wants something to be. So plan with your advisor, work with your financial professional and your tax person for the next couple of years, but definitely be ready to, have a year-round sport. As Coach
always
said.
Be ready to adapt.
There you go. Mm-hmm. All right, myth number 4, the $15 million estate tax exemption means estate planning doesn't matter anymore. But John, it basically only went up $1 million, right?
Mm-hmm. Yeah, so I always tell people that estate planning is so much more than what the estate exemption is. There's estate planning also has to do with your beneficiaries, making sure the right people get what how you want your estate divided up. I always like to point out to people that there are several states. I actually wrote a little list here. There are still states that have an estate tax. Real quickly, Washington, Oregon, Wisconsin, Illinois, New York, a lot of the New England states, New York, Vermont, Maine, Massachusetts, Rhode Island, Connecticut. And there are inheritance taxes in other states. So Nebraska, Iowa, Kentucky, Pennsylvania, New Jersey. So if
there's
you're
a lot.
in any of these states, that's a lot of states.
Yeah, you're still going to have to deal with estate tax in that state. You still got to pay
attention, folks. Yeah. Yes, you got to be on top of things. So that's one issue that people kind of forget is, I'm below the estate tax threshold federally, but there's still estate planning in other for your locality wherever. And
a lot of us are going to be under that one federally. I mean, it was 13,999 before. It was right at 14 million. So they just basically moved it up to 15. So it's going to take a lot for people to hit that one. True, but to your point, check with your state, but then also there's all those other pieces that take up into estate planning.
So many other things that go into estate planning. I still think that a long-term care is part of an estate plan, because what happens if you go into long-term care, it can deplete your estate pretty quickly. Does that mean you were over the estate exemption before? No, but you want to be able to leave something to your heirs. And if you have a legacy desire in your planning, this affects things. It doesn't matter whether that threshold's at 15 million, 5 million, or whatever it is. You're always wanting to plan ahead for what your wishes are. You've worked hard for your money. You want to make sure that the money is used as you desire.
That's right. Wasn't it the Pointer Sisters that said you work hard for your money, so you better do it right? So there you go.
Yes. I thought you were going to sing that.
Talking about I didn't. I just said it. I didn't sing it, but I pulled out. That was a good pull, though. It was a good random.
It was very good.
Yeah.
Yes.
All right. So, hey, Coach, I can deduct my car loan interest now, right? I mean, that's myth number 5. It's fully deductible.
Not quite, but sort of. I mean, the deduction is up to $10,000.
It's a
which
cap.
Is kind of nice. Yes, it's capped. That would be an expensive vehicle, in my opinion, but their cars are getting more expensive as we are
Very
experiencing
true.
here.
Very true. Some of these EVs are pretty pricey. Yeah.
Yeah, but really, if you're going to hit that $10,000 limit, you are getting a very, very nice car at that limit. So you're probably going to be under the threshold for most of us normal people that are watching this podcast here.
Yeah,
but there are limitations. There are phase outs as well. It's for new cars only, so it's not for the 2-year-old car you're getting at CarMax.
Correct. It has to be. It has to have been. I think you have to purchase it this year. I believe it was either January or something. You had to purchase it this year in 25, and it must. And I like this last part, Coach. The final assembly must be in the U.S.
Yes, it's got to be done here. So yeah,
final assembly. Right? So
what was that?
It was final assembly. So there's a little bit of a weird loophole there. What is final assembly? So I guess if half the car was built someplace else and then it was finalized here, maybe, I don't know. So again, there's some.
I think we're still trying to figure that part out. In fact, because I'm glad you pointed that out, because that was one of the questions we as preparers were kind of wondering. What exactly is final assembly?
Is final assembly?
Does that mean you're putting the tires on, and what is that?
Well, like when you see like a I forget who is it? Is it Honda? I think that manufactures a lot of their stuff in Tennessee. Whoever it is that's in Tennessee, they're always put on their commercials, assembled in, proudly in Tennessee. So maybe that's the thing, right? Somewhere in there. So obviously it was part of the, the jobs thing back here in the US. It's not a blanket write-off. Just know that basically.
No. And there is a very low income phase out as well for this. If you make over $100,000, it starts phasing out. So if you have a car with a lot of interest, you probably make a lot of money. So
right.
You're probably so this really is, once again, aimed at lower income people that are trying to get a new car. They're trying to spur the auto industry. That's very clear here. Yeah. But it is for lower income people that aren't rich beyond their wildest dreams, that maybe just want to get, I don't know, a Buick. You're just trying to get a car that will be a nice car.
I guess they do. Yeah. Well, it's funny, right? Whatever your stance is on the political situation or whatever the case is, we're not here to kind of debate that. Although it is funny, you did say earlier, like there's all the conversation about, well, it's just tax cuts for the big business and the super rich. And you can go dissecting things and find whatever you want to find to point out your argument. But if you do go read the summary from the congressional website, which we can put the link in the show descriptions this week if you want to go do that, because everything out there is filled with bias. Everything is filled with bias, right?
Correct.
So just read the summary, which is about 30 or 40 pages of the full bill. You don't got to read the whole 800. But the 30 or however many pages it was, but there's a 30 or 40 page summary on the congressional website. We'll put a link onto that. And that way you can kind of read through some of the stuff if you want to kind of really formulate your own ideas a little bit better versus just kind of buying into whatever bias. Anyway, final one, myth number 6, you can skip itemizing and still get that huge deduction for giving to charity, for example.
Depends on how much you think is a big amount to charity, because the limit is pretty small here. It's capped at $2,000 for married couples. Right. It is an above the line deduction, which is kind of handy. They've had above the line deductions in the past. Okay. Really small though, like $300. So this is actually a big bump for an above the line deduction. This doesn't preclude you from itemizing, but but there's a little bit of nuance here as to why would you be itemizing if you're going to take it here and so on and so forth. But because it ends up being, the math becomes very similar either way. So it's really helpful. Let's just kind of call it what it is. For people that do take the standard deduction, it's nice to have a little boost for your charitable deductions, $2,000, which is kind of nice. Now, I have clients that give a lot more than $2,000 to their churches and local charities. I have one woman that regularly gives $18,000 to $20,000 to her church. So the $2,000 really wouldn't matter for her. And so she would still either try to itemize. If she can't itemize, then what we would try and do is try and still figure out from a tax planning standpoint, take your $2,000 one year, but then try and bunch your deduction for the charitable deduction in the other year, and kind of go back and forth. We talk about bunching deductions. Yeah. So you still will be, if itemizing is something that you had been doing, you're probably going to continue to do it. But I do like this. It is a nice little above the line deduction. What I mean by above the line is that is regardless of whether you take a standard deduction, regardless of what your other credits are, this gets basically calculated in with your income. If you made $50,000, this reduces it down to $48,000 of taxable income. Okay. So it's before you start doing all these other weird calculations, you get this again above the line. Right from the front, right at the front of the line, you get this nice little deduction. So it's pretty cool.
Well, speaking of above the line, I got one more bonus one here I'm going to throw at you real fast. We'll do it pretty quick. And I'll poke the bear probably because tipping culture has gotten pretty crazy. The fact that, there's the no tax on tips part of it, right? So there's some stuff in there. So it doesn't completely eliminate stuff. There's a $25,000, right? I think that's the limit. That's the cap.
$25,000 is the cap.
Yep. And it phases out by 2028 as well. And starts to phase out for taxpayers who with their MAGI at over 150,000 or 300,000 for married, right? But there's the tip culture is out of control. This won't affect a lot of probably our demographic and folks that you service, but it could their kids or their grandkids who are maybe in service industries or tip industries. But I do think it's going to make the everything asking for a tip even like crazier, right? It just seems.
Yeah,
it's everywhere.
Yeah, it is everywhere. I do know that here in California, they do regulate tips at restaurants pretty heavily, believe it or not.
Okay,
that is something that is supposed to be calculated into your W-2, and there is a line item on there when you're calculating your Social Security. There's a different line item on your W-2 for Social Security tips because that's supposed to be calculated. There is a Form 4137 for you nerds out there. There is a form for calculating tip income on the tax return. So this will actually make it, a little bit different for employers to track the $25,000 of tip income. It will be exempt. So if you are an employer who's basically compliant, this might actually help some of you out there that do work in an industry that has tips, and your employer is on top of things, as far as keeping track of this. This will help you. But yeah, as far as tips everywhere, I see those jars everywhere. And my wife and
every screen, every business, they spin it around and they ask if you want to do, no matter whether they helped you or not. I saw a funny TikTok video or YouTube short, whatever it was. And it was the wife was making dinner and the husband was talking about how great it was. And she put up her little iPad and asked for a tip. So then he went out and cut the grass and he came back in with his little iPad and asked for a tip for cutting the grass. And it was like, hilarious. Okay, it's getting a little out of control for some things, but for the service industry, people who truly are in those trenches doing it, this is a nice little piece as well.
I should have had that as a football coach. After we win a game, have a little tip bucket for that.
Get your no. You gotta be in the new century, man. You gotta have your little iPad ready. You gotta just give it to the kids. Of course. Yeah. So the guys can Venmo you a little tip or something, right? So. Good stuff. Well, anyway, so again, for people in that industry, again, that's another little piece that could be helpful, but there are, again, limitations, right? So go check some of the data if you need to. Again, we'll put links in the show descriptions below, as always, if you got questions, need some help. Some of this stuff will affect our listening base. Some of this stuff will not. Make sure that you're talking with your financial professional on that. Coach is always here to help you. We'll have all those links in the show descriptions below. So go check that stuff out. And don't forget to subscribe to us on Apple, Spotify, YouTube, all that good stuff. Coach, thanks for hanging out here on Red Zone Retirement Program. We'll see you next time. I'll see you later, brother. Bye.
Advisory services offered through Mears Money Management, Inc., an RIA registered in the states of California and Texas. California Department of Insurance License number 0685203.